Welcome to Victory Business Forum from Celebration Church, Johannesburg. We have been talking for a while about pathways to wealth creation. The last month we talked about wealth creation through franchise buying businesses which are already in existence. And the month before we talked about startup businesses. And obviously to start up any business or to purchase a business or to acquire a franchise requires that we have the financial resources. So as promised, this month we are focusing on how to finance your venture. And we are honored I'm honored to have two guests. One will be our main presenter, is Mr. Enoch Mzenda, who is a banker by profession, working for one of the big banks in the nation. And the other one is my friend Dean DeMairo. So we are going to explore this topic. There's going to be two aspects to this. We're going to have a presentation that talks to the critical issues to consider when you are looking for commercial bank financing. And Enoch will give us a few tips on what to do and how to avoid some wrong things. So we are so excited to have him. And then Dean and I will join him in some discussions just to drill into some of the things. So right on, let's get ready, and we will get straight into the discussion in a moment. So welcome, Dean. How are you doing?
Thanks,
so
Doc.
Good to be
Thanks for having me. I'm doing great. How are you doing?
Excellent. I'm excited to be sharing this podium with you. And Enoch, thank you so much for accepting our invitation. So we're really excited. Please welcome and take it up, Enoch.
Thank you very much, Doc. My name is Enoch Mzenda. I'm the relationship manager for small to medium enterprises. I'm going to present to you today about commercial lending by banks. Right, I'm just gonna get into the background briefly before we can actually tap into the aspects that we're going to cover today. So in South Africa, if I can just say a little bit of some background, we've got 5 big commercial banks, and these 5 big commercial banks, they are Standard Bank, FNB, Absa, Nedbank, and Capitec. These banks, if I can say, they are classified according to a few forms that we actually use to classify the banks. These forms, they include the capital base, the asset base, and the client base. There are other forms that we do use to classify the banks as well. Why did I mention about the classification of the banks? Is because the size of the bank determines the risk appetite of the bank and the credit policy to adopt. So the bigger the bank, the higher the risk the bank is willing to take in terms of lending. So the focus of this presentation will be on lending mainly by the 5 big commercial banks. The credit policies adopted by the banks, they vary from one bank to another, but all the banks are regulated by the Reserve Bank. So the Reserve Bank controls the lending by commercial banks through the repo rate, interest rate, and the repo rate in turn influences the prime rate, which is the interest rate commercial banks charge their credit with clients. I'm going to now move on to the aspects that we're going to cover today in the presentation. So we are going to look at the types of clients that we have. We're also going to look at the challenges faced by small businesses. We're going to look at the lending products or financial solutions offered by the banks. We're also going to look at the requirements and supporting documents. We're going to look at credits and assessment criteria. And then we'll also dwell a little bit on the credit policy. What exactly is the credit policy? It's very important for us to just dwell a little bit on that. And then we're also going to look at the common decline reasons by the banks. When you submit your application, there are some common reasons that we often get as decline reasons. And then we're going to finish off by looking at the characteristics of a good proposal or application to the bank. All right, now I'm going to move to the types of clients. So basically, we've got two types of clients, which fall into two categories. The first category, we're looking at juristic clients. This is where we're going to dwell much on today. That will be our focus. So under juristic clients, we've got PTY companies, we've got NPC, which is the non-profit company. We've got a CC, which is a closed corporation. We've got clubs, we've got a sole proprietor, we've got trusts, we've got corporates, we've got incorporated companies. So all these types of companies, they fall under juristic clients. And we're gonna look at what is actually required when it comes to finance. On the other hand, we've got individual clients. So on the individual clients, we've got mainly three types of clients. So we've got the citizens, and when we talk of the citizens, we talk of South African citizens whose citizenship is by birth, or foreign nationals who have naturalized in South Africa and obtained a citizenship in South Africa. We also have, on the other hand, residents. These are classified into temporary residents. For example, someone who's got a work permit, or we're looking at someone who has obtained a permanent resident in South Africa. And then the last category under individual clients, we're looking at foreign nationals. So in the banking world, when we talk of a foreign national, we're talking of somebody who does not have any residential status in South Africa. So for example, we are talking of somebody who resides outside South Africa. He works outside South Africa, but you'd like to, for example, open an account in South Africa and apply for finance to finance, for example, say a property in South Africa. So that's what we define as the foreign national. So foreign national and a work permit holder in our banking world, we look at those people as two different people. A person with a work permit, we look at him as a temporary resident, and the lending requirements for these two different people, they actually differ. I'm then now going to move on to the challenges faced by small businesses. So what are some of the challenges faced by small business today? In a nutshell, I would say some of the challenges that are faced by small businesses, they include lack of capital, lack of industry knowledge in which they are trading business in, a lack of skills, a lack of resilience, shortcuts. Most small businesses or small to medium enterprises, they want to do shortcuts. In business, shortcuts, they don't get you anywhere. So in other ways, this is one of the main challenges that most small business actually face. The other challenge that is faced by small business today is the barrier to entry in the industry. We also look at the competition from the players already established in the industry, lack of borrowing capacity, the lack of time to focus on the business. What happens that sometimes you'd find that the person is full-time employed somewhere else, and then they start a business on the other side, and they don't have much time to focus on the business. It's also one of the challenges that small businesses actually face today. And then the last point, last but not least, the last challenge that I've put down here is chasing too many business ideas. You'd find that most small businesses, they don't really focus on one thing. They tend to look at, try to pursue so many things at the same time, which at the end of the day, you find that they are not able to achieve because they are not focusing and put their strength on one aspect. The next...
Enoch, sorry to interrupt you.
Okay.
Can we, I like those factors you are talking about. Can we zero in a little bit? Can you go a little bit deeper on the issue of what you mean by lack of borrowing capacity?
Okay.
Let's
Okay.
not, so that we don't assume on each other. What kind of, what exactly from a bank's perspective do you mean by lack of borrowing capacity?
Okay, all right. So what happens that with most small businesses, when you talk of the capacity to borrow from the bank, is that most of the people, when they start their businesses, they do not have their own savings in actual fact, or their own contribution to start the businesses. They start the business with the hope that the bank will be able to assist them to start the business. And yet on the other side, the banks actually have got requirements that they've got in place whenever it comes to lending. So you'd find that, for example, someone who is a startup or someone who has just started business for, say, for example, they've been in business for 6 months. They approach the bank and they say they want to get some finance to start the business. When the bank looks at them, number one, they would actually look at, first of all, there is a checklist that they'll provide to say, at least we need to see that your business has been running for, say, 12 months, so that you can provide us with full financials for the full year in order for us to be able to do a proper assessment. Most of the businesses, they won't be able to produce that. And then if, for example, let's just say the client approaches the bank to say, I want to finance an asset or a property. Then the bank would say, okay, fine. Because you are still fairly new in the industry, we would want you at least to put a deposit in order to mitigate some risk. You'd find that the small businesses, because they're also just starting, they do not have that contribution to put down as a deposit. So those are some of the things that the banks would look at to say, this person does not yet meet the criteria. We at least need them to be in the industry for some time, so that at least they can build some history, which we can base on in order for us to be able to provide finance to that client. Should I go through all of them, or is it fine?
Yeah, no. We were picking on a few things that I think Dean will want to come in a little bit. Yeah. So I think the critical issue here for our members is to understand that the bank is not there to just give you the money for nothing. They want to know that you do assume a certain level of risk as well. So when they ask to say, we want to see your equity, we want to see your contribution, what are you putting at risk? So that if you believe in your idea, before we put our own money, some people will think that, oh, I as long as I go to the bank, somebody did a business plan for me and told me that it's a bankable business plan, therefore I must be given money. So it's part of that borrowing capacity. So there are things that we can do to establish that borrowing capacity. Like Enoch was saying, make sure that you have, you know the criteria of the bank. If they want you to have done 12 months of trading with a banking transaction that show that actually you have funding, you have a capacity, your idea is proven, then you need to make sure that you are that. So don't rush to go to the bank just because you opened an account, you opened the company today. Make sure you put your own money. If you, some people will say, look, if I have family and friends who can help me as angel investors, we can come together and we put a little bit of our money as equity. So these are the things that we need to know to say, what are you putting so that the bank derives comfort? Did you want to come in to add anything right here?
Yes. So my question is, say if all I have is an idea, right? And okay, let me not say only an idea. I have an idea. I've got let's say I've got contracts, or I've got an offtake agreement somewhere, or I know where my suppliers are. I have little to no trading history. Do I still have the option to approach a bank to finance something I might want to do?
You've got the option to approach the bank. However, the application is not guaranteed that you actually get a positive feedback, because as the banks, they actually don't do contract lending. There is certain things that the banks actually expected to look at before they can actually grant finance. You might get contract today, but what happens that probably 3 months or 4 months down the line, you might fail to deliver as per the agreement with the contract. And then you find that after 3 months or 4 months, the person that is giving you the contract might come back and say, Mr. X, yes, we did sign an agreement, but according to our agreement, we were supposed to fulfill certain things, A, B, C, D. So given what your performance at this stage, we don't think we can actually continue with the contract. We have to terminate the contract. So what would then happen is that once the contract is terminated, the bank has already given you some sort of like finance, and now your repayment capacity is sort of like impaired, because where you were expecting to get the funds, the contract has been cancelled and you can no longer pay back. So that's why the banks would say you can, but there must be much more to that than just the contract, because they need to prove that you'll be able to repay back. If, for example, let's just say the contract is terminated, how are you going to be able to pay us back? So there are certain other factors that they have to bring in so that they can actually mitigate the risk in terms of lending. So the contract, yes,
so I think
be an add-on. Yes.
Yes. So sorry, I
Yes.
think what you are saying is there is a combo of things, criteria that you need to meet. But having that off-taker agreement, particularly if it's credible, if it's you have a trading history, it's actually a very great advantage in processing, having met some of the basic criteria. So I think it's something that you need to consider, to say, instead of just saying here is a plan, actually having off-take agreements, but not just off-take agreements, because people can go and buy some and say, look, just write this letter to say I have an off-take agreement and so on. But it should be credible, particularly if you can get bigger clients who are known to, who are credible. For example, if you are going to do something that you are going to supply, whether it is to government or there's some big organization which has a track record of kind of contract work along those lines, then the bankers can get comfort. But if you go to Marconi and you say, oh, I have Marconi's signature here, then they say, can we trust that? So the bottom line is to say, meet the basic criteria first, and then have those as a student. So if you have an off-taker agreement, you are a better off person in terms of the processing of your application than somebody who says, I don't know who my clients are. I know that there will be clients. But if you can demonstrate them, then I think it makes sense.
Correct.
Is that what I hear you were, Enoch?
Yes, that's correct. Yes, over and above the contract, there has to be, you have to meet a certain bank criteria in order for them to consider that application positively. Because with just the contract, we used to actually do, for example, when people get tenders and then they would go and extend credit against the tenders. But what has happened is that there was a time when there were so many irregularities that were found with regards to the issuing of the tenders, some of the tenders being cancelled and all that. And then you find that the bank has already granted a loan, for example, to a customer, and the contract is terminated, or the tender has been terminated. And now the bank is sitting with a situation whereby they can no longer get the funds back. So that's when the banks went on to say, you know what, even though there's a tender or even though there's a contract, yes, it will add value and it will make your application strong, but we still need you to meet it, at least the criteria that we've set up to say, this is what we need, A, B, C, D. Once you meet A, B, C, D, and then if you provide a contract, then that would actually make your application a strong application.
Excellent. Thank you so much. Yes, sorry for interrupting you, Enoch. You can go ahead.
All right. So moving along, then we will now dwell on some of the products that we offer. I'll just look at the individual side and the business side as well. But if there's any questions, you are welcome to just let me know along the way, and then I can actually give more information on that. So on the personal side, we're looking at personal loans, we're looking at home loans, we're looking at vehicle finance, we're looking at credit cards, we're looking at overdrafts, and we also look at revolving loans. So these are some of the products that we give to individual clients. Then we then move on to our main focus now, which is the products or the solutions that we've got for businesses. I'll start with I'll go through the whole list, and then I'll zoom into each and every product that we offer. And then we'll look at what are the requirements, what are the supporting documents that are needed in order for you to submit for that type of a solution. So the lending solutions that we've got for businesses, we've got a term loan, we've got an overdraft, we've got home loans, we've got commercial property finance, we've got vehicle finance, we've got equipment or machinery finance, we've got gap access, and we've got invoice discounting solution. So these are the main products that we actually offer to businesses when they approach the bank for finance. Then if I can just go back a little bit on the individuals, the requirements for example, if an individual wants to apply for a certain product or financial solution from the bank, the banks, they will just ask you for the 3 months pay slips, a copy of ID or valid passport with a valid permit, work permit. They will look for the bank 3 months bank statement, and they offer to purchase depending on the type of finance that you want to do. For example, if you want to buy a house or you want to purchase a vehicle, they will just need the code from the dealer or the offer to purchase. Then we then now move on to the business requirements. We go product by product now. So we start with the term loan. So the term loan, this is a 5-year loan, often meant for capital injection into the business, or some might look at it as the startup loan. So this is what most of the customers or the clients in their world, they would say is a business loan. Usually they grant it over 5 years. And what are the requirements for this? We'll then go into the requirements of what are the requirements of a business loan. Right. So the banks, they would need for you to apply for a business loan. They will need you to provide business financials. These are financial statements for the full year, depending on whether it's only for the first 12 months or it has gone into the second year or into the next year. They might also ask for management accounts. So the term loan as well, this is a loan that they give, but it's not unsecured. They need security for the loan. So they will ask you for a full cover security. So when we talk of security, we are looking at perhaps, for example, if you can come up with, or if you can bring a property that has been paid up in full, which is unbonded property, and say, I'm looking for a term loan or a business loan to do A, B, C, D, but I've got a property that has been paid up. Here are the title deeds. I can use this as a security in the event that I cannot pay back. You can repossess this house, or you can take this security, sell it, and recover your funds. So a term loan or a business loan, we need full cover security. They would also ask you for the company registration documents. They would also ask you for the director's IDs. They would also need a statement of asset and liabilities by the directors. So they need to see what assets, what liabilities, the income and expenses of the director. They would also need you to provide a 2-year cash flow projection. And then the most important thing that they also need to see is the business plan. So the business plan is actually, this is the blueprint, which is going to tell the bank your story of what you want to do, your idea to say, I'm going to start my business. So they need to know that, do you really know what you're actually getting into, or the business that you're actually getting into? So do you understand the market? Do you understand the challenges that you might face? Do you understand the strengths, the weaknesses of the strength, the weaknesses, the opportunities, the threats that exist within that environment? Have you done a budget for your business? So the business plan will basically say it all into the bank to say, this is what I'm going to do. And the bank, by going through that business plan, they'll be able to evaluate whether the business plan is a viable project or is something that has got so many loopholes. They would also ask you for a 12-month bank statement. So this is the requirement that I've just given now. Depends. It also depends on the strength of the business. You might find that if a business is a very strong business, they've got a very good credit history with the bank, they might say, for example, we are not going to ask for security. If they know that this business is a very strong business, but in most of the cases, they need security upfront to say, provide security, and then we're gonna lend to you. But of course, like I said, it might differ from one bank to another. Some banks, they might not ask for security. Some banks, they will ask for security. So on the term loan, I'm not sure, or a business loan, if there's any questions that we might need to ask before I can proceed.
Enoch, let's engage a little bit on that.
Okay.
I think there is this is a very good opportunity for people to be able to exploit this. I just wanted to know whether I know across the Limpopo, if the banks, they prefer a security, a full cover security on particularly residential homes, and not necessarily any other property. I think north of the Limpopo, they're a little bit more, they feel like more comfortable with your primary residential home than any other property. Yes. Is that the same situation here, or it's?
Yes, so it is the same situation. However, they can also look for example, if you've got an investment that has got a cash surrender value, they can also look at it. For example, let's just say you've got an investment, which at the end of or at the expiry, it can be actually converted into cash. They can also take that, and they can also take that as security as well. So they don't really have to take the funds, but they will pledge the funds for the duration of the loan repayment. So it can be your residential house, or it can be your it can be an investment that you've got that, for example, if that's going to mature in the next 5 years, what they'll just do is that they will just need to take like a session of it so that you won't be able to access it. And then once you default or you cannot pay back, then the bank will actually take some steps in order to recover their funds from that. They can also use commercial property, but what they will do is that with commercial property, they will not look at it. For example, if you are looking, I'm going just to give you an example. If you are looking for, say, 200,000, and for commercial property, they don't normally, they look at probably 70% of that. That's the value that they would actually give on the commercial property as compared to the residential property.
Yes, I think if we just zero in on that a little bit, I think two things I want to look at. Number one, when we say residential property, I was trying to make a distinction between your primary residence and for example, I can have 3-4 properties. So north of the Limpopo, if you are going for your third property, they are not as interested. They want your primary residential home. That gives them more security. So that's what I was saying. Does the same apply here?
So what happens that? So what happens that in terms of security, they are looking at an unbonded property, or a property that's actually fully paid with title deeds. So it can be, for example, if you've got 4 properties, as long as you've got the title deed for that property, they are happy. It doesn't really have to be the house that you're staying in. or your primary residential house. It can be any other property that's paid up in full. So what they will just do is that they will go out and do valuation and see how much value they can actually get from that property. And then depending on that value, then they can say, for example, if the property is worth 500,000 and you are looking for, say, 450,000, they will be happy to provide that. If the property is worth 500,000, you are looking at, for example, 500,000, they can also do the same thing. So it doesn't really have to be your primary residential house. It has just to be a property that's paid up in full. And what they would need is that they would need the title deeds, because they will have to go to the deeds office and register that property. That's correct, yes.
Yeah. Excellent. I think that's beautiful. That's the advantage actually here, because like I said, north of the Limpopo, they normally want to zero in on the residential, on your primary residence. Now, we don't recommend, particularly for business, that you pledge your primary residence, because if business goes south, you are going to lose your primary home. So if you have invested in your other properties, it's always better to use the other properties. Then the second thing that I wanted to zero in on, Enoch, was to say, we spoke about if you have any other assets that can mature. Are we talking here about the possibility of, for example, a term insurance? If somebody has a life insurance that is for 5 years, for example, and it has a specific surrender value at the end of the 5 years, could that be taken as collateral in this case? Or I want to get in a little bit deeper to say, what exactly practically are we looking at in terms of that security if it's not a landed property?
Okay, so a life policy will not really, because the life policy, if I look at it, it will be, for example, they will only pay it out in terms of, say, for example, death, or say, for example, let's just say disability. What we're looking for now is like, for example, you've got an investment, or you've got some funds that are tied up somewhere else. And
like a money market fund, for example.
Yeah, like let's just say maybe a money market fund, or it can be probably a fixed deposit investment that you cannot access now. You need to get some funds now, but your investment is only gonna mature probably in the next 3 or 4 years. So we're looking at an investment where at the end of the term, it does have a cash value, where they can simply, for example, the bank can easily recover the funds and then use them to pay back the loan.
Okay, sorry for pushing on a little bit more. It's just to make sure that it's people are clear. Would generally, I'm speaking generally, of course there are specifics.
Yes.
What would happen to an equity portfolio if somebody was to surrender JSE stocks or something like that?
The challenge with that is that because of the fluctuations that happens, because what the bank would actually look at it, they would want to look at something that is got, for example, a stable, fixed, where I would say where the capital is guaranteed. Because what happens with the shares is that sometimes, depending on the markets or the volatility of the markets, you find that you might lose probably half of your the income that you might have probably invested in shares. Whereas what the bank will be looking at in terms of the investment that is for the cash value is that they would need something where there's a capital, where the capital is guaranteed. So if you are going to, for example, ask the bank to give you 5 million in your investment, there must be at least a minimum of that 5 million guaranteed at the end of the term, to say, come what may, even if things go bad, that 5 million should be there. So the bank would want to see that 5 million, say, even if the markets go bad or if anything goes wrong, we know that this capital is guaranteed. The 5 million will always be there. Whatever will be yielded on, over and above the 5 million, yes, it's fine. We don't have problem with that, but the capital must be guaranteed.
Okay, excellent. Thank you so much. I just wanted to because the issue of security is normally a big issue in terms of this. I think the other things seem a little bit clearer to me. I'm happy if my colleague Dean does not have any other issue around this, then we can proceed. Dean, you can come in if you.
No, I'm happy you can proceed.
Yes. So let's go ahead, Enoch.
Okay. Yeah. So yes, as you have just said, now the issue of security is actually it's very, very, very important. The reason being is that in most of the cases, if I look at what we call small businesses or small to medium enterprises, most of them, they actually don't make it within the first, say, 2 years. So previously, the banks used to lend without asking for security, but because of the failure rate, that was actually the failure rate of the small businesses or small to medium enterprises, they had to implement some sort of like risk mitigation measures to make sure that they will be able to recover something if things go wrong. And this is also where most of the small businesses actually, or small to medium enterprises, they actually find it difficult because they would come, some of them, they might have very good, brilliant ideas, but the challenge would be to come up with that security. Because now, if you are just starting now and you're looking for capital to start your business, you've got a good idea, where will you actually get the security? So that's the question that is always most of our customers would ask to say, but then where would I get security? I mean, yes, you might say I must put down my house as security, but obviously with business, you never know. If things don't go well, it means that I'll be out on the streets. The bank will come and repossess my property or my residential property, and I've got no roof over my head. So security is very important when it comes to the banks, but it's also a very big challenge for especially small businesses or small to medium enterprises that are just entering into the industry, and they are required to provide that security. So
and I think if I jump in right here before you move on to overdraft, I think security, yes, is a big issue. But I think if you have a vision and you see where your business is going, sometimes you can go past this by bringing in equity partners into the business who may be able to provide the security. So as a founding team, you can actually put together, but you have to have somebody who actually sees the value in your business, and they see that they can have a return. So there are ways that you can manage this by thinking creatively and say, look, do I want 100% of nothing, or can I actually bring in somebody else who has assessed my business, understands what it is, and thinks they can get value, and they can put in the equity. So all these kinds of things can be done to make sure that you sweeten your ability to be able to attract those funds.
Correct.
Yeah.
Well said. Correct.
Yeah.
That's correct. So I'll now move on to the overdraft. So the overdraft, it's a lending facility given on a business check account, and it's often to bridge debtors, but this might vary from one bank to another. What are the requirements for you when you want to apply for an overdraft? This will be specific to one bank. So, because with other banks, they just look at an overdraft as a facility as a short-term facility, actually, as a short-term facility to just be able to cover up your cash flow. But with some banks, they look at it as a facility that they give to bridge debtors. So they will look at your check account, and they would want to see that it is well conducted. They will ask you for the financial statements and or management accounts. They will also need to see the list of your debtors and the debtors age analysis. When we talk of the debtors age analysis, they want to see your debtors to see, for example, because normally the debtors, they are categorized in 30 days, 60 days, 90 days, 120 days. On the other side, if for example, you've got debtors that have gone to more than 120 days without you being able to collect from them, the banks would look at it as bad debt. They would say that you have already failed to collect from those debtors. If it's within 60 days, 30 days, is something that the bank will still be able to say, yes, we can look at this and assist the client. But once you've started going up beyond 60 days, then it's now sort of like a red flag to say something's not going well. Yes, you've done business, but in business, usually what happens that it's one thing doing a business, and it's another thing also getting paid. You should have a strategy to collect, or you should have a plan in place for you to be able to recover the funds for the goods that you've provided or for the services that you've provided. So an overdraft, it's a facility that's usually given. It's very quick when you apply for an overdraft, just to bridge your debtors. Then we move on to the home loans. So as a business, you can actually buy a property, a residential property, through the business. I would say home loans, this type of finance is catered for purchasing a residential property over a period of 20 to 25 years maximum. So the maximum that you can finance a property is 25 years. So the LTV, or the loan to value, it goes up to 100%. So they can give you 100% for the loan for the property that you want to buy. So for example, if the property is going for 700,000, they can give you 700,000 loan. Previously, they used to go beyond 100%, where they would help you with a cost for transfer and registration. Then they would give you, like, for example, 120% point. But nowadays, they don't do that. What they rather do is to give you a discount on your attorney fees or on your transfer or registration fees. But the maximum LTV, or loan to value, that you can go for on a residential property is 100%. So this property, it must be zoned as residential and not business or commercial for it to be financed over a period of 20 years to 25 years. So usually when you're buying a property, it's very important to make sure that if you're buying it as a residential property, it must be zoned as a residential property. If you're buying a business property also, it must be zoned as a business, or it must have business rights on it. Otherwise, there will be problems, because you can get the finance, but at the end of the day, they'll come back and say, we're very sorry, because we have found out that this property, although people are using this property as offices, this property is still zoned as residential. So that might also pose a challenge. So with the residential property, usually they go out to do physical valuation, or they can do desktop valuation if they've got the figures already, just to ascertain the value of the property before finalizing with the loan. So what are the requirements that banks would want clients to provide when they want to buy a residential property? So it will be financial statements and management accounts. They would ask you for 6 to 12 months bank statements. They would also ask you for a signed offer to purchase. Depending on the strength of the business, they might also ask you for a deposit. But if they can see that the business is liquid, is solvent, profitable, they might just go for 100% as well. They won't ask for a deposit. But if they can see that the client is not very strong, then they can say, at least we need to see your own contribution to say that you believe in the property that you're going to pay. Let's go, give us something. We meet somewhere halfway. Then the next product that we're going to look at is commercial property finance. So commercial property finance is a little bit different from the residential property finance. Number one is that the finance for purchasing commercial or property with business rights. For example, when we talk of commercial property finance, we're looking at, for example, a factory, buying a warehouse, or office buildings. So number one, the property should be zoned as industrial, or it must have business rights. And then the maximum term that they can actually go for is 10 years. So as compared to the residential property, commercial property, they can only go for up to 10 years. So that also means that depending on the price, your installment might be double if you were to buy, for example, a residential property. And the maximum LTV, or the loan to value on a commercial property, is 70%. It also depends, but in most of the cases, they don't give 100% on commercial properties. The maximum you can get is 70%. You would need to come up with it, for example, a 30% deposit in order for them to be able to finance a commercial property for you. Unlike a residential property where they can go for 100%, a commercial property, they need a deposit of 30% at least. So what are the requirements for purchasing a commercial property? So they would need financial statements. Obviously, these are audited financial statements, management accounts. They also need a signed offer to purchase. They would also need a proof of deposit. They might ask it up front if they can see that this client, according to the bank statements and according to the financials, the client might not have a deposit. They might ask it up front so that it doesn't really take much of their time to go all the way to approve, and only the client to come back and say, I don't have a 30% deposit. So they might even ask just a proof of deposit up front. Then with commercial property, they can also ask for a life policy to be seeded, and also a comprehensive property insurance to be seeded as well. And then the last thing that they would also need is bank statements. I'm not sure if you've got any question on the commercial property finance.
No, I think we are okay. If you
Okay.
Go to the next two quickly, and then we can zero in much more on the requirement, the issues of actually making sure we have a good. Let's move quickly on these ones for the now.
Okay, all right. So the vehicle finance to purchase, that's for obviously automobile assets. The maximum term is 7 years. The bank often finance less than 5 years assets without a deposit. Deposit might be required depending on the age of the asset or the strengths of the client. So what are the requirements? The requirements, it will still be the same things. Financials. They would need also the quote from the dealership for the car that you'll be interested in. Equipment finance or machinery. This type of finance is tailored for equipment or machinery purchase. They usually do it over a period of 48 months and not more than that. The deposit may be required. If, for example, you're buying a machinery or equipment over the value of 500,000, they might need you to do a technical inspection first. So what are the requirements for equipment finance? They would need a quotation from the seller. They would need financials and management accounts. They would also need a deposit if the deposit is also required. Then we move on to the invoice discounting solution. So this type of finance is specifically aimed at customers whose intention is to release some cash from their data sooner through the bank at a discount. So basically, they only look at blue chip debtors for the bank to discount the invoices. So the bank will give you money, and then they will do the collection from the clients at a later stage. So what are some of the requirements? They also need the financials, management accounts. They would need the list of debtors, and they also need the data stage analysis as well. Then the gap access. So the gap access, usually this is aimed at those merchants or those clients that make use of card machines. Wherever you go, for example, you go to Pick n Pay, you swipe. So this solution is aimed at assisting business who make use of card machines with card machines. Lending is done against the turnover of the card machine. Repayment periods are the range from 3 to 18 months. What are the requirements? So you must have a card machine, and your turnover should be above $1 million per annum in order for them to give this type of finance. Then we move on to the credit assessment criteria. Okay, so banks usually assess
before you do, Enoch.
Yes.
I think Dean wanted to ask a question or to comment just a while back. Dean, do you want to come in?
So I've noted it. I'll ask it at the end, so you can continue.
Okay, that's fine. Thanks. You can go ahead.
Okay, so let's look at the assessment process or the credit assessment criteria. Okay, so the banks, they usually assess an application before approving it or declining it. So what happens during the assessment, or what do the banks look at in order for them to say we are approving this or we are declining this? Some of the things that they look at, for example, they look at the conduct on the existing facilities and the account itself. So they look at your account just to see how you conduct your account. And also they look at other existing facilities. For example, if you've got an overdraft, you've got a credit card, how are you actually conducting on those accounts? So they also look at the scorecard. So every client will have like a risk rating that they get, that they actually allocated to, which depends on how you actually conduct your account. So this is usually done through the credit bureau, whereby everything is automated. So if you conduct your accounts very well, from time to time, your risk rating will actually improve. They also look at the risk behavior of the client, for example. If you are, for example, your clients who always pay late, having overdrawn accounts, bouncing debit orders, late payments, this behavior is actually not in line with what the bank would want their customers to do. It's not in line with what actually the banks would prefer when actually it comes to lending. So they can also look at the current credit exposure of the client. So you'd find that some people or some clients, they're actually overcommitted in terms of the facilities that they've got to the banks. So you'd find that they've got several loans that they already have, but they still want to get more loans. So according to them, the minute you have more or your credit exposure is a little bit higher, according to the banks, they look at it as a red flag to say that if anything goes wrong, we might not be able to recover our outstanding amounts because there's just so many other facilities that the client is got open. The other most important thing as well that they look at is affordability. So they look at you and say, will this client be able to afford to pay back the loan on a monthly basis? Will the client be able to service the loan? So if affordability is in order, they will be more than willing to assist. But if the affordability is not in line, they might ask you to say, if you were asking for, say, 400,000, they can say, we can only give you 300,000. Then you need to come up with a deposit because your affordability can only afford so much. The other thing that they can look at as well is that if a client comes up with a deposit, it's a good thing because it mitigates the risk. It can also work in your favor in terms of getting a favorable outcome from the bank. They also look at the security offered. Is there any asset that's backing? Is it secure-based lending or is it unsecured lending? So, for example, if you're buying a property or if you're buying a car, there is an asset behind the lending. So that sort of like gives comfort to the bank. Unlike when, for example, someone's taking a personal loan where there's no asset behind the lending. And if, for example, the person can no longer pay back, the bank will have to follow other channels in order for them to recover. But there's no asset for them to take and sell in order to recover the funds. They also look at your primary bank. In most of the cases, the banks, they also look at your application favorably if you are their main primary bank. They can see that, obviously, if the payments are coming in, they first go into that bank. So from the collection point of view, it gives them some sort of comfort that if anything goes wrong, we'll be able to collect first. So the primary bank, it does plays also an important role. They can also, so when they look at your financial statements, these are the things that they actually look at. 4 things. They look at the liquidity of the business. They look at the affordability, they look at the profitability, and the solvency as well. So these things is that when you talk of liquidity, is the ability of the business to pay short-term loans or short-term commitments. Will the business be able to pay short-term commitments? Profitability, from the profit, this is where the business will be able to repay back the loan, and it also works hand in hand with affordability. And then in terms of the solvency or gearing, they would want to see in terms of your capital, the breakdown of your capital between your equity and your loans that you've obtained outside. They would want to see what the ratio is. Is the business highly geared, or is the business sort of like balanced? Then the last aspect that they also look at in terms of when they actually do the assessment is the credit policy. So the credit policy, it does actually guide assessors whenever they are actually assessing the loan. So I'll just now zoom into the credit policy. So the credit policy, I'll say,
okay, if you hold on that,
yes.
Sorry to interrupt. I think before you move from there, I think for our viewers and our members, I think there's something that Enoch said, kind of understated as a banker. You know, bankers, they can say something very profound and say it as if it's just by the way. If you look at the issues he talked about in terms of your credit assessment, he talked about the performance of your existing facilities and account. He talked about your behavior in terms of credit assessment. You know, these are things that are under our control, and these are very critical. So it's important to make sure that your credit score is in good standing. So before you even go to the bank to say, I want to go and borrow some money, make sure that your credit rating is okay. And many people don't even take time to go and check what their credit rating is with the credit rating agencies. It's important to be able to actually go and say, look, I want to see my score, see where there may be things that are wrong in your financial standing, not because you are defaulting, but because somebody somewhere did not keep the records straight. So you need to be able to look at your credit score, make sure it's cleaned up, make sure it's okay. So these are things that you can do to improve your successes in accessing finances. Secondly, many people don't realize that it's important how you transact well before you start thinking of doing business. So if you are doing business, whether as a corporate or as an individual, there are people who are always watching. They watch how you handle your finances. If you are not handling your finances well, when you now want to apply for a loan, that will work against you. So integrity in your handling of finances, on your personal finances and on the company's finances, is very critical. These are things that we can do something about. We can clean them up before we even go to the bank to apply for our funding. So it's important that as a general principle, particularly as a believer anyway, it's important to make sure that your finances are always in order. So it's important for us to think that far and say, am I handling my finances okay? Because we must always realize that there's somebody who is always watching you. The bankers are always watching your account, the performance, the conduct of your account. You then say, oh, it was the devil, it was something. It was simply you mismanaging your finances. So it's important to manage your finances well. And I wanted to underscore that because many people think that it's outside their control, but it is actually under your control. It's things you can do to make sure that you become more credit worthy. So back to you. Sorry for the interruption, Enoch.
Correct, no problem. All right, so the credit policy. So this is sort of like a framework under which the assessors actually should work within. So it stipulates, this is like the Bible for the assessors, for the bank. So it gives guidelines on what the banks actually do for finance, the do's and don'ts in terms of assessment. So it stipulates the assets which the bank is willing to finance, the types of clients to finance, the maximum loan to value for different assets and clients, the risk appetite for the bank of the bank as well is in the credit policy, the credit loss ratio of the bank, the issues of deposit requirements, all these things actually they are within the credit policy of the bank. So the credit policy of the bank is the one that would say, for example, if they say for foreign nationals or for people with work permits, our policy is that we don't give more than 50% loan. They need to provide, for example, a 50% deposit, or they need to provide a 20% deposit. All these are actually within the credit policy. So it gives the assessors guidelines so that there is sort of like uniformity within the assessment environment. So the assessors from time to time, they refer to the credit policy in order for them to get guidelines. Then we go on to the common decline reasons that we normally get from or give to our clients. So number one, it's lack of affordability. The client comes to the bank, apply, but there's no affordability. They cannot afford what they want to buy. The bad risk behavior of the client as well, which is the conduct that we spoke about. If the conduct is not good, even if affordability is there, the bank won't be happy to extend a loan to such a client. Even though if the client says, I'm going to put a deposit, in most of the cases, the behavior, it tells them that even though if the client puts a deposit, but we're going to have a problem with collection of this client because the behavior is just not right. The third point is a presentation of the application as well. Sometimes the application is not properly presented to such an extent that the assessors might not understand exactly the application, which might even lead to the decline. Then there's also, for example, a lack of a deposit or on contribution. That might be another reason for a decline as well. Then sometimes the information provided is not enough. This can also lead to a decline because the assessors will just work with the information that they've got, or the bank will work with the information that they've got. If you don't provide some other information that might make your application look, or someone who's looking at the application to think otherwise, then they just deal with the information that's there and actually decline. Sometimes after the decline, the clients or the banker might go back to the client and get more information. That might also change the situation whereby a decline turns out to be now an approval, but simply because there was insufficient information, the application was not approved. Then also where they need security, then that can also be another reason where they would say, give us security. The client cannot give us security. That can also lead to a decline. Then when the exposure is also too high, too many loans, that can also lead to a decline. And then there's also an out-of-policy lending. So like I explained before, that the bank has got a policy to say, these are the parameters or these are the areas that we want to work within, the framework that we want to work within. Outside this, we won't be able to assist. Then we move on to the last part of it, which is the qualities of a good application. So for a good application, we would need to see that there is sufficient supporting documents as the checklist provided. So if they tell you that we need A, B, C, D, if you provide all the documents as per the checklist that you're given, that's number one. It will work in your favor. Then a business plan as well. If you've got a business plan that is actually viable, that will actually work in your favor, because the business plan is a blueprint. That is what's going to define whether the bank would actually grant the loan, or they might say, no, we're not convinced that this is a viable project. So if you've got a very good business plan, that would actually definitely work in your favor. And there's certain aspect that you need to include in your business plan in order for it to be a good quality business plan. And then they would also need to see your business financials, and they must pass those. They must pass the criteria that we spoke about of affordability, liquidity, profitability. Then some form of a deposit. If you provide a proof of a deposit to say I'm applying for this, but because I believe in it, here's my deposit. That would also add on to a very good application. And then the directors themselves. So what happens that, yes, the business might come to the bank and say, we are lending to the business. But as you know that even though the business is a juristic client, that which can also sort of like make this, not really to make decisions, but what happens that the directors of the businesses always have influence into the business. So the behavior of the directors also might affect the lending of the business. So the business might have strong financials. There might be a very good business plan. There might be everything might be in order. But if the directors, for example, in their personal capacity, they do not conduct their accounts very well. For example, they've got ITC issues. That would also impact on lending the business, because what the bank says is that although we are lending to the business, but it is the directors that actually makes the decisions of the business itself. So if the behavior of the director is not right, that might also translate onto the business at a later stage. So that might also affect. So your behavior or your behavior or your credit history must also be in good order. And if you've got a very strong assets and liabilities base, that might also be a good thing on your side. So they would look at your net worth in terms of your assets minus your liabilities to see how much you're actually worth in terms as an individual. That would also add on to a very good application for the business. And then they also, if you can just provide a motivation explaining exactly what the situation is, that would also help the assessor to understand exactly what is going on within the business before they can actually make that decision of granting the loan. So I think if you've got anything that you might need to...
Thank you so much.
Yes.
Yes, thank you so much, Enoch, for that powerful presentation.
Okay.
If Dean can come back in, I think we have just some 5 to 8 minutes where we can have a little bit of discussion before we go to our interactive session. Yeah, I think one of the things that I want to emphasize here is the importance of your handling your finances well. I think Enoch has underscored that even as directors, your credit ratings, your performance, your net worth, all those things are important. And so it's important to not just think that the paper you are completing is the whole story. So who you are, how you are handling yourself, can you be trusted? An organization or a business is as good as the people behind it. So the banks are going to be looking at that. So we need to look at ourselves and say, okay, this is what I am. This is what I'm doing. If you find, for example, that you may not be as strong in terms of your balance sheet. This is again where I said again, and I will say it one more time to say, sometimes you may want to say, if I see value in this business, if it can actually do well in the long term, and it has prospects, being able to have somebody else buy into your business, instead taking equity, particularly people who can add value. That is very important. A lot of SMEs, they don't want that. I want to be 100% of everything. But look at even an IT or even a big company going in to raise more capital. The first thing they do is to go get some private placement. They get some anchor investors who invest so that it increases the credibility of what they're offering. So as an individual, that's one of the things you can do to say, you know what, I don't have to be 100% of everything that I own and then become 100% of nothing. So there are some people who have seen this, they see the value and they would like to co-invest. They may be angel investors, they may be family, they may be friends, or they may be colleagues. That's why you find even in a lot of these international companies, you don't have a founder, you have co-founders. somebody has an idea, they go and look for somebody who say, can you be my co-founder? Can you put in some equity? What are they doing? They're trying to borrow the credibility to increase their creditworthiness or their value to the people who are going to invest in them. So as individuals, particularly when we're thinking business, don't just think solo. Think about, how do I add value? Can I bring in somebody on board who can help me and increase my net worth and the value that we have as directors? So those are the kinds of things that we can bring onto the table, and it can add value. So it is important to think long term, to think in terms of saying, how do I add value to what I am? How do I give comfort to the people who are going to the providers of debt, to the providers of even other people who are going to come and invest in me? So that is very important, and I strongly encourage that. Think beyond just being a sole proprietor. And I think you can correct me, Enoch, if you will.
Okay.
I have a sense that I served once as chairman of a loan review committee of a bank, and so I kind of have some sense here and there. Sometimes, but that was years ago, so the sense may not be there. But sometimes when you have an individual, even if it's a company, which is 100% owned by one person, there's a certain level of risk that's attached to it. That is reduced if you have 3 unrelated people saying, look, we are the co-founders, we are the equity partners. It gives a sense of comfort to say, okay, if something happens to this person, there's still 2 other people who are driving this business. We have a vested interest. So it speaks to a going concern of sense, in a sense, than just being an individual. So I just want your thoughts, Enoch, to say, is this something that you as bankers down here consider? In my time, when I sat on the loan review committee, those things were important.
Okay. Yes, it does. It is actually very important because what normally happens is that, for example, if the business is owned by one director, obviously the one director might influence the business in a certain way. But if, for example, if there's, say, for example, 3 directors, the chances that, for example, if the director were to misuse the funds, of course, yes, it does happen. But when there's 3 different people or 2 different people that comes to say, let's get into business, this is our objective, this is what we want to achieve. That element of one director, for example, being tempted to do certain things, it's sort of like diluted when there's 2 or more people on board. So it does actually help when there's more than one director. They look at it differently. As long as those 3 directors, like I said, their credit standing, they've got, for example, their ITC or their conduct is also, and their also background in terms of their statement of assets and liabilities or individual balance sheet. If they're also in good position, then that will definitely work in the company's favor when an application is actually submitted for assessment.
Thank you so much, Enoch. Really appreciate your time. We are going to go into a Zoom interactive session where we can actually engage with Dean, Enoch, and myself, and other people, where we are going to go a little bit more practical, and you can ask questions, you can give your experiences, and we can learn much more. It will take just 40 minutes of our time. But this is a brief overview of how you can access bank financing. And I think the critical things that Enoch talked about are very important. And if you take a closer look at what makes a winning application, you need to understand that most of these things are actually under our control. There are things that we can do and should do well before I go to apply, to say, how do I structure myself? How do I make sure I am credit worthy? How do I make sure that my record is clean with the credit bureaus? How do I make sure that my handling of finances is excellent so that I can give comfort? How do I make sure that I have a diverse, a stronger business promoter profile that can help? So all these things are important. So this is one way we can access funding from the banks, like we said. And next month, we want to be talking about another way. I think there's something that didn't talk about, didn't ask the question about off-takers and so on. And from a commercial banking perspective, while off-takers are not as important, although they are critical once you've met the other needs, but there are also other methods of funding, particularly here in South Africa. There are national empowerment funds and all those kinds of things. So we hope that next month we'll be able to look into those, and you'll find that their requirements and their access is completely different from banking. So don't start ruling yourself. We are presenting this as one option. If this suits your needs, then you need to go banking. If it doesn't, we are going to present a number of other options so that you can see where you'd fit and what can help you. But one of the key things that I want to keep emphasizing is, if you are willing to bring others on board, it's much easier for you to access funds. If you, particularly when you know that there's a weakness, a slight weakness in your balance sheet and your network, then you can actually enrich that by bringing other people on board. So just as we close this session, I want to give Enoch just one more time, what would be your critical foundational insight that you want to give somebody who is going to access funding from the bank today? There is a takeaway that you want people to take away with them. This is it. Just one principle.
Okay, so I would say if you'd want to approach the bank and apply for finance, number one, you just have to do your homework first and make sure that it's not an application that when you submit, you pray and say, I hope it will go through. It has to be an application whereby you yourself as a client would say, if I was the bank myself, I would approve this loan. Definitely based on certain points, A, B, C, D. It does actually meet A, B, C, D, and I don't see any problem in lending. Just for the client to put for example, to put themselves in the shoes of the bank to say, if it was my money and someone comes to me and gives me this project or present this proposal or project and say, can you give me money? Will you be able to lend that based on the information that's provided? So number one is that before submitting an application, you just need to do your homework to find out what is it that is required. And then just make sure that before they come back or pick up certain things, you've already addressed those things to say, if, for example, you know that perhaps there was a month that things didn't go well. For example, I had some debit orders that actually bounced, which sort of like tainted my credit records. You can actually put an explanation to say, this happened because of A, B, C, D. If it's a valid explanation, the banks will actually accept that. So what just needs to be done is that before submitting an application, a client just needs to do a homework, gather as much information as possible, provide all the supporting documents, so that when the application actually gets submitted, you will actually get a positive feedback.
Thank you so much, Ms. Timzenda, for working with us and helping us. So right now, a link for the Zoom interactive session is being posted, and we meet you there, where we just go in depth for 40 more minutes, and then we will be done. Thank you so much, sir. We really appreciate you. And thank you for everybody for joining us. We hope you had a wonderful time. So thank you, Mr. Mzenda.
Thank you very much.
Thank you so much. And so God bless you. For those who are signing off air, we meet again next month, same time. For those who are joining us in the Zoom interactive session, see the link and click on the link, which is being posted right now, and we meet you there. Thank you so much, and God bless.